Okay, so very good morning and welcome you all. And this is our second topic in our course called Corporate Finance and Risk Management. And the topic that we shall study today is leverage and firm valuation, that how the companies leverage. Leverage, if I would explain much about it later, but if I have to say a few words about leverage, I would say it's basically debt. That how important is debt in your company's financing. And not only that, it provides you a source of financing, but it can also have a lot of knock-on effects in the company. For example, it can do several things to the company's valuation. It can make company very successful, but at the same time, it can make the firm bankrupt as well. So where is the fine line? Where is the thin line? Where is the optimum? So all these things we shall discuss in this topic. Yeah, but before I go forward, I want to have a quick recap of regression beta that we discussed in a previous meeting. Do you know that we discussed about slope? And in the slope, we discussed that a company, for example, has the stock return is not a dependent variable. The stock return is basically, I should say that it's depending upon, or I should say that the stock return is not an independent variable. It depends on, if I can quickly draw it, I can draw this whiteboard. Maybe you can see it, the blank screen totally here. We discussed it last time that if this is the so if this is the x-axis and y-axis, and this is how the linearly related the firm stock return is with the market stock return. So for instance, if I want to write some text here, so if I say that this is BP stock return, British Petroleum, and if I could say that this is FTSE 100. FTSE 100 is the index of the top, is the biggest 100 companies in Great Britain listed in London Stock Exchange. So FTSE index value, index return of the value. Then I can see the linear relationship here. Okay, sorry. And here you can see that there is a change in the horizontal portion. Yeah, I hope you can see where I'm highlighting it. So this is change in the FTSE value return, FTSE value, and then there's a corresponding change in the British Petroleum stock return. And this relationship, if I call this portion as delta Y, and this as delta X, change in X and change in Y, then what we get by dividing delta Y by delta X is called beta, the measure of systematic risk. This measure of systematic risk, as you learned last time, that you can use Excel function, it works fantastically. You just have to get the slope function, and then it works fantastically. This is also called regression beta, because we can get this by regression method. In the regression, you know that there's a one dependent variable which depends upon one or more independent variables, and their association, their relationship, how sensitive they are, we measured with the regression beta, okay? So here I can say that if regression beta is, in this example, with the BP stock return depends on FTSE 100 index return, and if that beta comes to be 0.6, so I can see that for every 1% market rise, there is 0.6% BP stock price, the stock return, not price, but the stock return goes up by 0.6%. But at the same time, if the market goes down, market means in this case, FTSE 100 index, if that goes down by 1%, then the BP stock return will go down by 0.6%. And this sensitivity, this responsiveness of a variable, dependent variable, upon an independent variable is called the slope, or in this case, beta. Beta in finance is used as a measure of systematic risk. Systematic risk, you know, that the risk which come from the market. And if you remember, we had a lot of discussion last week about this company, Finnair, comprehensive analysis. And there we had a lot of discussion about it, that how we are calculating the systematic, the total risk, and how we split up total risk into the market risk and the firm specific risk. So this is some background of regression beta that we shall be using here. So this is the background of regression beta. There are some problems with regression beta. Some of the problems are very visible. First of all, the standard error is very high. The standard error is that which we normally get or experience by excluding some variables. And if you see that in this equation, you see only one dependent variable. Well, the dependent variable is always one, but the most important thing is that here the independent variable is only one. That is a market return, okay? It could be market return, could be, as I drew this picture, it could be FTSE 100, it could be S&P, it could be NASDAQ, whichever market we are using. But the problem is that since we are not taking many other variables, the stock return does not depend entirely on the market return. It depends upon several factors. Those other several factors which could have an impact on the stock return, they are not included. And with that, when you do this analysis, your error level can be very high. And this error level comes because of the omitting of some key variables. Another reason, another cause of the high standard error is that, I go back to the slide. Here, if you see, the relationship between the company stock return and the market return is assumed to be linear. Linear means, as you could see the picture, I drew a straight line on the y-axis and then going up with along the x-axis. That's a straight line. What made us believe that the relationship between the company stock return and the market value is linear? This is our assumption, okay? This assumption can be wrong. So we don't have any strong reason, or we don't have any anything to any prophecy which says that the relationship between two variables is linear. It could be non-linear. It could be a graphical. So if I can quickly draw the same thing which I drew before, yeah. So the relationship could be like this. It could be like this. It can be like this. It can be like this, like this. Why not? So all kind of forms which highlight the relationship between BP stock return and the market stock return are possible, but we are stuck to the point we are very stuck that, hey, you know what? The relationship between the firm stock return and the market index return is linear. We have no reason to believe it. We don't have to take it as a priori, as a assumption, but we do it. So because of these some kind of assumptions, it's quite possible that the standard error is high. And higher the error, lesser is the reliability of your test statistics. Okay. And the second mistake, or the second error, I won't call it mistake, the second error which we can see in the slope function in the beta value is that it only takes historic thing. Okay. It's historic value. It doesn't say the future. It's not futuristic. So what we do, we take 20 years, 30 years, and we feel very proud of, oh yes, we have the data of last 30 years, 20 years, but that's historic. That data is in the grave. It doesn't show the futuristic. For example, if a company last 3-4 months have been making very big efforts to change its business mix, its technology, bring very strong organizational changes, its board of directors is undergoing very serious changes, they're making a product mix, they are, sorry, they're redefining their processes. So all these innovative things, all these dynamics, they are not covered by this linear relationship. Okay, so it's too historic sometimes and too static. It doesn't show. For example, you have two companies, Apple and Microsoft. You draw the same way the beta of both as against NASDAQ. One company may be overly innovative, where the other company is not making much innovative efforts for last some months. The beta coefficient does not incorporate this fact. It's too technical, too static. And thirdly, the choice of index could vary. Your beta depends upon the choice of index. Okay. For example, I go back here. Here, in the example that we were covering, we took the index. The index we took was FTSE return, yeah. But what if I change my index to FTSE 250? The top 250 companies listed in LSE, or FTSE all companies listed in the LSE. So when your independent variable is changing, the beta, you will have a separate data, new data, and that will have an impact on the beta as well. So the beta depends upon the index, the benchmark you take. Okay, so your first benchmark was FTSE 100, then FTSE 250, FTSE all. So you can't expect the beta to be constant for all different indexes. It would definitely change. Okay, so these are some of the limitations which we often experience when we are calculating the regression beta. About the second point, I want to say you something more, is that according to one school of thought, this regression coefficient beta does not really incorporate the technological or the organizational innovations or the market innovation or even the financial innovation which company is going through, because it's too static, it's too technical, too formula type. But the counter argument is that if you make any change in the company's setup, organization, innovation, anything, it becomes a news in the financial media. It gets known to the investors. The financial media writes about it. Investors start thinking about it. And all these thoughts about innovation, organization, and all these changes which the companies are making, or even there are some macroeconomic developments, like the state is planning to increase tax rate. So all these things, not individually, but as a one stream, all put together, reflects through the index value. So basically, your market return incorporates all these changes. So basically, there could be 10 more variables which could potentially affect the stock return of a company, but all of them are coming together and reflecting through one common channel, and that is the stock price of the company. So people who are very much in favor of beta, they say that you don't have to have 10 separate variables to measure the impact on the stock price of a company. Rather, all these variables, all these changes, qualitative changes, all these other variables, which are macroeconomic, which could be about innovation, technological breakthroughs, they all are reflecting in the stock price and the index value. So therefore, beta is okay. That's the point. I'll give you an example. I'm not happy with this explanation yet. Imagine there are some political factors. The company is set up in some country where there's an extreme degree of political instability. There can be an army coup anytime. There can be the government can be dethroned. The prime minister could be arrested anytime, could be replaced by other, and then it goes on. So extreme climate of political instability. You don't have to take a variable called leadership quality. You don't have to add in the regression equation the frequency of prime ministers change. You don't have to add the variable how strong is the army and so on and so forth. All these things, the strength of the army, how frequently the prime minister is changed, all these things are interplaying, and their combined mutual interactive effect is on the market stock return. And the market stock return have an impact on the company stock return. Do you get my point? So therefore, you don't have to have those additional variables. The market index, the index value incorporates all these unmeasurable things. So basically, when you have only one variable, the return in the market value that incorporates all the measurable, non-measurable, financial, non-financial, economic, business, social, psychological, all these changes, all these impacts, all these variables, these are measured by this variable called RM, which in turn have an impact on return on the company stock. So therefore, beta is not that bad either. That was my point. Okay. What are the factors which determine beta? The first factor which comes to my mind is the nature of the product or services offered by the company. Cyclical companies whose cash flow is not stable but fluctuating from season to season, they have a big impact. So I would say that if a company is making ice cream, will have a higher beta than the company which sells grocery, because the demand for ice cream is very seasonal. It's more in summertime and comparatively less during the winter. But we all eat food, certain staple food throughout the year. Okay, I can say that the tourism industry is going to have a higher beta than a housing company, for example, because the tourism companies, the beta is fluctuating, is high because the cash flow is more during certain time of the year, whereas in certain time or the other times of the year, the cash flow is comparatively lean. Okay. Similarly, the second point is the luxury goods. I think this point we discussed last time, that to understand the beta, it's good to know the microeconomics. And we have a concept of microeconomics called elasticity of demand, which says that how your consumption changes in response to the change in your income, for example. Okay, and we discussed last time that if the income increases, do we start eating more? Or if the income goes down, do we start eating less? Well, you can say yes, but it's not so instantaneous because we have the comparatively fixed consumption patterns. Okay. On the contrary, if you are planning to buy some luxury house, which is it could be a dream house, and if the price of that dream house is going down, or if your income is experience a substantial rise, that distant dreams becomes achievable. On the contrary, if you are planning to buy something luxurious and your income shrinks or the price of the product goes up, you can easily postpone it. Because it's not something life-threatening. I mean, one can die without food, clothing, and shelter, but if you don't have a luxury home, you can still have a house somewhere, I guess, to live in. So the goods which are highly income and price sensitive or elastic, they are supposed to have higher beta. And those goods and services which are more flat, they're less sensitive to the income and the price changes. They would be having a comparatively smaller beta. And you can see I gave you an example of two companies. The first, energy, it provides electricity. It's a very famous electricity company. It provides the energy. And last time when I saw the beta of this company, it was about 0.20, which means if the market increased by 1%, this company's stock return increased by 0.2%, which means the market impacts this company's, the market impact on this company is 1/5 than the average. On the contrary, we have Taylor Wimpey, which is making very luxurious holiday homes and these kind of apartments, which only very rich people can afford it. You have to be some football player or some Hollywood actor to buy them in very exotic destinations. Their beta I saw last time was 4.34, which means the market change and the impact on this company is 4.34 times than the average market increase or decrease. Okay, so that's why it depends upon. So you can postulate, you can make some kind of assumption that the beta of Prisma, Lidl, K-Market, Walmart, Tesco would be lower. On the contrary, the beta of some luxury brands, you know what luxury brands are, okay? That would be much higher because these are luxury goods. And this third point is concerned with the second point. And the fourth point is that the growth firms should have, yes, the companies, because the growth companies, they are growing very fast, but at the same time, the probability of the downfall is always higher than the average company. So you can see that the growth companies can have the higher beta as well. The next concept which we will be discussing, and in fact, one of your tasks you will see in the next couple of slides, maybe task 5, is based on this concept called operating leverage. Okay, and the concept of operating leverage is based on the fixed cost, that how big are the fixed cost as a percentage of your total cost. For example, when you study the income statement of a company, you will find that some companies have more fixed cost than others. Like I can see that BP has so many times of higher fixed cost than Microsoft or Apple. Yeah, I can say that the hotel industry, industry has so much substantially higher fixed cost than a financial institution. Okay, so it could be possible that two companies, they can be having the same level of operating profit, they can be equally big in the stock market, but we also need to dig deep and explore that what percentage of the fixed cost is there, you know, in the total cost. And very often the fixed cost is adjusted in your operating cost. You know the operating cost? Yeah, because if you see the income statement, how many of you have seen income statement of a company? If you look at the income statement, the first thing you have is the total revenue, and from total revenue you minus operating cost, and operating cost include the production cost, you know, the raw material and everything. But at the same time, they also include some other expenses like administrative, distribution thing, which are not directly involved with the production of the commodity or a service, but they are essential to operate. Like the salary of an accountant, the salary of a driver who is delivering the product from the factory to the store, they're not production cost. But can you live without the services of the driver who drives the lorry from the factory to the store? It's not possible. Okay, so then we include all these production cost and the other operating cost, and the label is operating cost. And all this fixed cost, which are involved in this whole, you know, this production line, these are including the fixed cost of the company as well. So therefore, the operating profit, when you have the operating profit, which is equal to total revenue minus your operating cost, that gives you an idea that how big or small the operating cost are in your company. Okay. Once again, the companies which have a lot of administrative things, bureaucracy, lots of tangible assets, you are giving the production, you're giving the products, not the services, a lot of packaging, a lot of transportation. These kind of companies, they have higher fixed cost, and that could have a adverse effect on their operating cost. I give you an exercise. Look at the income statement of a IT company, let's say Apple, and compare with the income statement of some oil company like BP or Shell or Chevron, and see the items in their operating cost. Maybe you will hardly see anything in case of an IT company, but in case of these oil companies, you will see so many components of their of the operating cost. Okay, so operating cost, which include fixed cost, have a very big impact on your operating profit. Okay, so if you are a fundamental type of analyst who's analyzing the company's past data, operating leverage can be a very interesting topic for him or her. Okay, so we move on, and this is just an example which shows that which sector is having the least leverage and which sector have the highest leverage. And you can see that the IT companies have the least leverage Leverage means debt. But if you see the financial services, well, the financial services are based on debt. They get debt and they give debt. But the automobile or the electric companies or the paper, the hotel, cable, all these companies, they are so much based on debt. There we go. The formula to calculate operating leverage is here. And you can see that operating leverage is calculated by percentage change in EBIT. Yeah, you know EBIT? EBIT is the earnings before interest and tax. In some companies, they use the word EBIT, the earnings before interest and tax. In some companies, they call it just simple, flat, operating profit. In some companies, they call it PBIT, PBIT, profit before interest and tax. In some companies, they even use the word income, I. So it's like a PBIT, EBIT, and IBIT, which means incomes before interest and tax. But anyway, the idea is that this highlights your operating profit. It's not including the interest and tax. Interest and tax, they are your financial costs. You borrow, you pay interest. It has nothing to do with the company's operations. It has nothing to do with the company's production of commodities and the delivery and these kind of things. Interest is a financial cost, which is not an operational cost, unless you're a bank. If you're a bank, if you're a financial institution, then interest is your operating item. Because the banking business is based on debt, basically. You get debt, you give debt, okay? So unless you are a financial company, the interest is not a part of your operating profit. But if you're a normal company, normal means a non-financial company in the automobile, the consumer goods, then you don't include in the earnings, or you don't consider the interest and tax expenses. So you only take the operating profit, okay? So operating profit is equal to EBIT or PBIT or IBIT, okay? Once again, even though it's more to do with the accounting and less to do with the finance, but I would say that we have two concepts of operating profit. The one operating profit is called gross operating profit. And the gross operating profit is called EBITDA, EBITDA. So EBIT, earnings before interest and tax, D stands for depreciation, and A stands for amortization. And the gross profit is EBITDA, and the net, sorry, not gross profit, gross operating profit is called EBITDA, earnings before interest, tax, depreciation, and amortization. And the net operating profit is this EBIT, which I just mentioned. Okay, the earnings before interest and tax. Okay. Yes. And then this we divide by, and by the way, why we take EBIT? Because EBIT incorporates the impact of fixed cost. So higher the fixed cost, smaller would be EBIT. And smaller the fixed cost, higher would be EBIT. And this we divide by the percentage change in the revenue, okay? And if this number is higher, it's a good sign that, hey, your company is doing a great job. Your profit, your operating profit, a measure of company's performance is rising faster than your total sales revenue. So this is a good sign. But if this coefficient is constant or shrinking, you need to investigate. You need to examine that, hey, what's wrong with the fixed cost? Is it going up? Why so? Is something wrong with the cost control? Are you wasting something? So you have a topic to investigate, okay? Here I have some fictitious data. And you can see that we have some data. We have sales in the second columns, net sales. And then we have the percentage change. And then we have the earnings before interest and tax, which is your operating profit, basically. And we also have the percentage change in earnings before interest and tax. And the percentage change in sales and percentage change in EBIT are calculated by, you know that we have the current value minus previous value in the bracket, divide by the previous value. If you want, I can show it to you. I can quickly draw, I can quickly make a spreadsheet, and I can discuss with you, okay? So if you just bear with me, I can open a spreadsheet. Some blank one. Am I sharing it with you? I think so. Yeah. So if I take here sales revenue, so if I have sales revenue here, which could be in $1 million, let's say, I don't write the sign, as long as it's same. And here I take operating profit, so it's EBIT. Here I can write all the names. It's also called PBIT. It's also called operating profit for sure. And it's also called income before interest and tax. So different names. I mean, accountants are not academics, so sometimes they just mingle many phrases, even though they are conceptually wrong, but who cares? They're accountants. So here I take the data, let's say 2014, 15, 16, 17, 18, and 19. And let's say we have the sales revenue, 100 million, 120 million, 112 million, 128 million, 130 million, and 135 million, or maybe, okay, 135, no problem. Oh, not this much, 135. And then we have the this EBIT, the operating profit. It's 23, 22, 19, 25, 28, and 32 billion. Now, here we can find the change. So, for example, change in the revenue. So, because we are going in the ascending order, which means from the old value, from the past to the present. So here, all right. So what we do here, we have the current value, 2015 year, 120, minus the previous. Use the brackets, otherwise it could be a big error, and the past value. So here, the current minus past divided by the past, and we drag it down. And the same thing we do here, we find the change in the operating profit, which is equal to the current. Use the brackets carefully, minus past, previous, divided by the previous. And then we go drag it down. Okay, after we have these values, we find the average for the whole 4 or 5 years data. So we use the average function, and then we drag it down. So average D4 to D8. And the same thing, we find the average here. So let's highlight them. These are the average. This is the average sales revenue, average sales revenue. And this is the average EBIT, or average operating profit. Okay, let's highlight them a bit more. I would save this. I would save this file and share with you in Optima. And then we calculate the operating leverage. Which is equal to this divided by this. So I can say that as long as your operating leverage is more than 1, you are doing good job. Okay. Or if you are comparing on year-on-year basis, and if your operating leverage, even though less than 1 but over the time it's going up, it's a sign of recovery or a sign of progress. But as long as your operating leverage, as a rule of thumb, operating leverage more than 1 is considered to be good. So if I have to make a comment, I would say that for every 1% increase or decrease in the sales revenue, there is 1.20 approximately, or 21 percentage increase or decrease in the operating profit of the company. So this is also a sign of sensitivity. Okay, so this is the concept of operating leverage, and it's quite simple. I can save it and I can share it with you. Operating leverage example. And I can add in the operating leverage example. So based on the operating leverage, you are having a task. And the task is that you will be calculating the operating leverage based on at least 5 years data obtainable in the financial statements of a chosen firm. Like in your task 2, 3, and 4, you will be having actually more than one company in those tasks. Yeah, you know that because you're making a portfolio. So you pick only one company which you have chosen in your portfolio, just one company, and take the last 5 years data of the company's operating profit. And then you have the company's sales revenue. And based on that, you are supposed to calculate the operating leverage of the company based on the last 5 years data. So normally when you open the income statement or any financial statement of a company, you will get at least 2 or 3 years data. I think if you open the income statement, it's quite possible that you get 3 years, but if you open the balance sheet, it's for 2 years. Because this data is obtainable from the income statement. So I think you have to open maybe two income statements. So take 5 years data of operating profit or the operating income, and then you would take the data of the company's total revenue or net revenue, doesn't make much difference, and then find out the operating leverage and see how your company, how your profitability is sensitive to the company's revenue, basically. So that's what I expect you to do in task 5. Yeah? You okay with this?
Yeah, thank you.